The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Foundation podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
Now, I'm sitting with a great friend of mine, a fellow mining investor. He appeared on the show a couple of months ago, and the title of his show was A Mining Cynic Speaks. He is, of course, John Wolstencroft. John, hello, welcome to the show. How are you doing?
I'm very good, thank you.
And today we're going to be discussing how a mining company, which apparently looks like it's on a PE of 1, can quickly take itself onto a PE of 100. So I suppose before we go through the process of how a mining company devalues itself, I should say that, John, you've been investing in junior mining companies for what, 12 or 13 years?
Probably since around 2002, 2003.
And I imagine that you've made good money on some and lost good money on others?
Yes, unfortunately I've made more than I've lost, but history could have been different.
Yeah, absolutely. And I think what happens to anyone who invests in these companies is that initially, when you first get into it, you just think these are amazingly exciting companies and I'm going to earn a fortune. But over time, you do become cynical.
I think that's true, and I think the industry itself has to take some responsibility for the initial enthusiasm that new investors sometimes exhibit, because these companies do need to raise money and they do need to promote their story. They're not saying, well, this is a company, if you want to invest in us, fair enough. If you don't, we don't really care. We're just here to sort of spread a bit of investor information around. They actually actively need to support the share price and get investors into the company. And so they tell very convincing stories with very large numbers. And often people will try and sell their company on the basis, for example, of the value of the gold in the ground, which can, even for a small junior worth a few $1 million, could easily be hundreds of millions, if not billions of dollars. And of course, gold in the ground is also known as dirt. It's getting it out and getting it out and mining it and turning it into real tangible metal that is what miners should be doing.
Absolutely. Bill Reid is fond of saying not all ounces are created equal.
Absolutely, yes. And sometimes these small companies just don't have the strength. They have fantastic assets, but if you have an asset that needs 2 billion, for example, to get into production, it's way beyond the capability of any small company to raise that sort of money. And therefore, in their hands, those assets aren't actually worth very much unless a major will come along and do a deal. And majors often don't come along and do deals. And often
it's very rare that they do come along and do deals.
Yes, and of course, with sort of selective memory, we remember all the companies that did do deals and not all the ones that still are sitting on assets 10 years later waiting for the phone call from a Rio or a BHP to say, yes, we'd like to buy into your asset. That is actually quite a rare occurrence and is becoming more rare, I think, as companies go for larger and larger mines. And a lot of these sort of smaller deposits, there's no real option except to go into production, which I suppose is what we're talking about today, is how would a junior company, seemingly on a fantastic valuation, get into production, and what does the valuation look like 12, 24 months later?
Okay, before we go through this self-destructive process, the self-destructive cycle of mining, do you want to give a bit of background about the two big...
Yes, the reason why I sort of like telling this story is it's sort of absolutely true, because I've made many sort of large calls on individual companies in the past 10 years or so. But my biggest ever call was in a company called Silvercorp. And in fact, I think Kathy Fong, who was the president of Silvercorp, might have been on your first ever show back in 2007. I
think it was like second or third, yeah. And she was absolutely brilliant. And what a brilliant salesman and what a thorough thinker and everything else.
Yes, and that company did very, very well. And now I'd met Kathy probably a year or two before that show, when she was the president of, well, she was actually at the time that you did the show, but she was the president of Silvercorp. It was a junior company, assets in China, with an amazing story that was too good to be true. They had fantastic grades. They had contractors that would build adits, which are horizontal tunnels into the side of a mountain. They dig those out for free as long as they could keep the waste material, because the silver grades and lead and zinc were so high when they were doing exploratory tunnelling that the contractors didn't want paying. They just come along and do everything for free. Extremely high grades. They did a 43101 and proved up several million ounces of silver, very low capex to get into production. It was a fantastic story. Of course, then it was in China and nobody believed her when she went round to tell these stories. But then about 2 years later, a lot of it had actually come true. So a stock that was trading at $1.20 to $1.50 rapidly rose to around $20 as this story materialised. And the main reason why I invested in this stock is it really did seem to be on a forward PE of 1. That is, if you look at the market capitalisation of the company, which if I remember was around $50 million, a year later, when they were in production, it would appear to be throwing off, miners love this throwing off term, throwing off cash of $50 million a year. $50 million market capitalisation, $50 million a year in cash flow, fantastic. PE of 1, what a bargain. Well, I invested in it. The stock did rise dramatically. I put a quarter of my net worth into this one company, which in hindsight was a ridiculously foolhardy thing to do, but it paid off, and I'm very pleased that it paid off. And obviously since then, that money that came out of Silvercorp after tax, which was a significant amount in those days, the days of 40% tax, went into other companies, and I've done well on those. But after Silvercorp, I was looking for my next big story. And I found another company, South China Resources, listed on AIM, that seemed to be almost an analogue of Silvercorp. They were mining for molybdenum, not silver, lead and zinc. But there were so many features in common with Silvercorp, in the sense they had contractors working for free as long as they could keep the waste. They'd build tunnels into the side of the mountain. It was very narrow vein, but extremely high grade molybdenum, almost pure molybdenum sulfide. Very low capex to get into production, just a few $1 million. They thought they could get into production in a year. The story, there were so many parallels, and I remember posting on a bulletin board 12 parallels between Silvercorp and South China Resources. And so the amount of money I'd originally invested in South China Resources before it 8, 9, 10 bagged, whatever.
Silvercorp,
Silvercorp. I put into South China Resources, and it all seemed to be going well for a few months, and then the news releases stopped, and it seemed to be getting a bit suspicious about why the directors weren't releasing news. And it then turned out that yes, there were these veins, but there wasn't enough of the molybdenum sulfide to turn it into a viable mine, and the stock went from 7p to something about 27p, and I think I probably sold my last shares. I've got 5,000 left. I sold my last shares at 1 or 2p, and so that was a big loss for me. And now that was also on a forward PE of 1. So here we have two stories, both apparently on a forward price earnings ratio of 1. One did very well, one basically went bust. As it happens, neither would have ever been on a PE of 1, even if all that good news, jam tomorrow, had actually materialised for reasons that we'll go into. And sometimes I'm sort of maybe lying in the bath at night, and I think, goodness gracious, if I'd have invested in South China Resources first rather than Silvercorp, I'd have put a quarter of my net worth into a company that went bust, and I would probably have given up and walked away, and I'd have my portfolio in a unit trust now.
Isn't that interesting? And I think there are plenty of people who did put their money into the equivalent of South China Resources before they had their Silvercorp, who now never want to touch junior exploration, junior resource stocks of any kind, and that's why you have this awful kind of boom bust cycle, if you like, in the junior resource sector.
I think that's right. I think the investors that you meet at investor meetings or when there are management presentations, they're the ones that have survived, so to speak, or had the good hits, and the ones that don't tend not to turn up anymore because either they've become very disillusioned or they've run out of capital, or both. And as an aside, I did actually know. I
mean, think how much money got lost last year, and think how much money got lost in 2008.
But not just in the big crashes. I remember in I can't remember, it was 2006 perhaps, or maybe 2007, before what we considered to be the sort of great financial crisis. Someone I knew investing in oil stocks, in junior oil stocks, and he made £500,000 in around 5 months spread betting on oil stocks. He was leveraged 3 to 1, but as the prices went up, he'd put all that profit back into to getting more and more exposure into oil stocks. A 3 to 1 leverage. he probably had £1.5 million worth of exposure, £500,000 essentially of profit on a 3-to-1 leverage ratio. And then all stocks corrected. We go through corrections very severely, very dramatically. Gold yesterday down 5%. It's not a shock if you've been around in this market for 10 years. And you read the Financial Times or you read King World News the next day, and the wisest people say, well, this is what this market is like. The market ticks up slowly and then drops dramatically, and then ticks up slowly and drops dramatically. It's happened time and time and time again. Correction in all stocks, that 1.5 million exposure fell by a third, so your $500,000 capital disappeared. And so the person I knew went from being an employee working as a software engineer to retiring in January, to retiring in May with $500,000 of capital, and by December he'd lost all that money and he was back working as a software engineer.
I know exactly who that was. Anyway, there we go. Nice guy as well.
Yes, very nice. Often
mistaken for a policeman. He was. He'd go on the tube and people would always think he was a policeman, although he never was. So let's go through this cycle of how a mining company goes from how a junior mining company goes from a potential PE of 1 to a PE of 100.
Right. So here we go. You're reading a bulletin board one day, and somebody says, "I found this fantastic company. There's 100 million shares out." And it's going to be producing 100,000 ounces a year at a cash cost of $500 an ounce. And let's assume, to make the math simple, gold is $1,500. So it's going to be making $1,000 profit an ounce. 100,000 ounces times $1,000 is $100 million. So we have 100 million shares out, $100 million profit. Let's say the share price is currently $1 a share or £1 a share. It doesn't really matter. I'll use dollars because there are many more companies on the Canadian exchanges than AIM, which is perhaps another issue to talk about. And therefore, $100 million market cap, $100 million profit, PE of 1. Pile in, fill your boots. Fantastic story. This is what I did with Silvercorp. This was the story at Silvercorp, and this is what I did. And it's all looking very good for a few weeks, and then the people that have piled in suddenly start hearing about they need to raise some capital to build this mine. They've done the feasibility study and it's all there and everything, and they can go into production, but they actually need to raise $200 million to build this mine. And people say, oh, don't worry, most of that will be debt. Well, of course most of it will be debt, but they'll still have to raise maybe a third in capital, and a third to 2/3 ratio, or 30-70. These are pretty good ratios when you're trying to go into production. That the banks that are financing often want to see a capital raise as well, and so the market gets whispers of a need to raise capital, and so the share price starts drifting back. People are selling out in order to buy in a bit later. The share price falls to 66 cents. It's fallen by a third, not uncommon at all. We probably all remember Shanta Gold last year that did one of these financings and halved in value in a few months. So falling by a third isn't particularly a terrible drop. These are very volatile stocks. And then they have to raise $66 million, 66 cents. That's another 100 million shares they have to raise. Bad news, we've now got 200 million shares out, but everything else has stayed the same. So, okay, they're not on a PE of 1, they're on a PE of 2. It's still pretty good. It's fantastic. Some companies are on a PE of 20. But what we also forgot was there were some warrants when this capital raise occurred. Very commonly in Canada, but also in the UK, Chryso Resources, as some people call it, did some fundraisings in the last few years, and they issued warrants. And it turns out, as well as the 66 million shares, there were 33 million warrants. 66 million fundraising, there were 33 million warrants also issued. And the company need some working capital before they go into production, because the money they're raising is the money to actually build the mine. And between now and starting the mine build, there's all sorts of stuff they have to do, and they're doing some more drilling and proving up some more resources. So that 33 million sort of goes pretty quickly. So we've now got 233 million shares out. Everything else stayed the same. So it's a PE of 2.33. And then they start building the mine. Everything's going absolutely fantastically. and then it suddenly turns out that the mine is going to cost a little bit more to build than everyone anticipated. And even though bankable feasibility studies have the name bankable in, or a lot of people use the word bankable, very, very commonly they don't actually end up costing what it says in that massive document. It ends up costing more because historically there's been very high price inflation in the industry.
Yeah, the oil price goes up.
Oil price goes up, the price of zinc and steel and other things go up. And it turns out they need to raise another $33 million, which isn't much of an overrun on a $200 million mine. 15%.
I've not known one mine to go into production on budget.
So there we go, another $33 million, but the market's really getting quite pessimistic now, and it's fallen to 50 cents a share. So that's another 66 million shares that have to be issued. And now we have 300 million shares in issue. Everything else stayed the same. It's all looking good. This is definitely the last fundraising before we go into production. It's a PE of 3, but who cares about that, because miners are on a PE of 25. We all know that. We'll talk more about that later. And then someone downloads a presentation from the website, and there's something about this 25% free carry on the mine owned by the government. Now, this happens a lot. It happens much more than people really realise. It might not be the government, it might be a minority partner, but often in the small print you will find a company saying we're going to produce so many thousand ounces. We actually produce those ounces, but we don't own all those ounces. We're the producer, but we're not the owner of all of them. Oxus was a famous example from the very early days. It did very well. It went from about 10p to 70p. It's probably about a penny now. Unfortunately, and Oxus only had half the mine. They had to build everything and take all the risk, and they only had around 50% of the mine. So it's not 100,000 ounces, it's actually 75,000 ounces because the government gets a quarter. Don't worry about that. 300 million shares out, 75,000 ounces is a PE of 4. Still pretty good. Miners are on a PE of 20. And then you look into the small print even more, and it turns out the government has also got a 2% net smelter or 2% royalty on the mine, not net smelter, 2% royalty on the mine. And there's some bloke with a beard and glasses somewhere that found the mine in the first place, sold it for a pittance years ago, and he's got 2% as well. He's got a 2% royalty on the mine. And that means instead of getting $1,500 when we sell the gold, we're only going to get 1,440 because the government's taking a couple of percent, and this original bearded prospector is getting a couple of percent.
All prospectors have beards.
I should have just said prospector then. It's superfluous information. So it's still looking pretty good. We've got 300 million shares out, 75,000 ounces, only a few percent this royalty, but that makes the PE 4.26. And then somebody reads the report, the annual report, and it turns out some of the directors have got some options from years ago that no one thought they'd ever be sort of exercising, but now it seems like we're going into production. Turns out there's another 30 million options they can exercise, and of course all the money that comes from that exercise goes straight into working capital requirements. And so there's actually 330 million shares out, and not 300 million shares, so the PE has risen from 4.2 to 4.6. And then we come to the dirty little secret of the mining industry, which is sustaining capex. It's very, very rare in any presentation for a mining director to say, our cash costs are this and our sustaining capex is that. Now, sustaining capex is what you need to do on a capital basis to keep the mine running year in, year out. The initial capex is what you need to do to get into production. So you might do some pre-stripping to get rid of all the dirt on top. You might build some tunnels or whatever. But then once you're in production, you need to build some more tunnels, or you need to do some more stripping. And everyone has sustaining capex. And I was once talking to what is currently a darling listed on AIM and in Australia that has very, very low cash costs. I was talking to the one of the directors of this company, and they were claiming they can get gold out of the ground for about $200. And I said, oh, fantastic, amazing margins. What's your sustaining capex? He said, oh, I think we can do everything else for another $200. Now, I don't want to say who that company is because it was an offhand remark, and I didn't get it from the accounts. But that $200 cash cost could double, could go to $400 because all the extra things they need to do to keep that mine running year in, year out. Let's say we've got $150 sustaining capex here. So instead of us spending $500 to get an ounce out of the ground. We're now actually spending $650. 330 million shares in issue, everything else stays the same, PE 5.5. Still a fantastic bargain, all the bulletin boards are saying. Now, of course, mine is a depleting asset. We've got to think about exploration and drilling. This is only a small company. It's only doing 100,000 ounces a year. And I think it's fair to say that $4 million a year in exploration of greenfield targets around the mine site, and maybe $4 million of infill drilling or drilling close to the pit or whatever they've got. That's
and that extension that they've always been talking about.
That on-strike extension they've always been talking about. 4 million plus 4 million for exploration and drilling. Those are not big numbers for a small miner. As an example, Petropavlos last year, I think, spent $80 million. It is a $1.5 billion company, but they spent $80 million on exploration to prove up new assets.
Yeah, I mean, I once said this to Bill Reid, who I've already quoted. Bill Reid has built 6 or 7 mines in his life, and Goro is one of the stories. Gold Resource Corporation is one of the stories that did actually do what he was going to say, more or less, although he came in over budget. But one of the things you asked Bill is, you say, what's your exploration budget? And he says, I have no budget for exploration. It costs as much as it costs.
Yes.
He won't put a cap on it because he knows how important it is.
But very importantly, when he first presented his company, he said, we're going to mine, make money, a third's going to go on tax, a third's going to go into exploration development, and a third's coming back to the shareholders. And by and large, he's keeping to that promise.
Yeah.
It's very, very rare that any mining executive talks about returning anything to the shareholders at all. Anyway, we need to do some drilling. That's another $8 million a year. So the profits were sort of around $60 million before, which got 330 million shares out at $1. The $1 buy-in price, that was a PE of 5. Because we're spending $8 million, the PE is now sort of 6.5. And then, of course, we've got to run the office. All these costs we're talking about, these are the costs in the field.
Yeah.
Getting stuff out of the ground.
Office in the city.
There's the office in the city. There's all those. There's the Nomad. All those advisors. There's the people.
Conferences, hotels, lunches.
$3 million a year. I mean, if you can do all that for $3 million a year, you're a very astute and careful spender of money. So we're putting in $3 million a year for G&A. So that brings the PE down to 7. And then we just before we go into production, we get some bad news that it's not going to be $100,000 ounce a year mine. Well, it will be in a few years' time, but there's actually a ramp-up period. Of course, the directors have been talking about 100,000 ounces a year because that's what it will be doing in a few years. But actually, it's going to be 67,000 ounces a year, 10% off for the first year. I read a presentation last year that looked at all the bankable feasibility studies over a period of 2 or 3 years and what they were predicting and what they actually mined. And the variance was from minus 50%, so that's mining half of what the bankable feasibility study, which might run into hundreds of pages, said, to plus 100%. So it's by no means bad news.
Yeah.
But often there is a ramp up, or it doesn't quite work out. The only certainty in this business is you're not actually going to mine what you expect. You'll either mine more or you'll mine less. Yeah. And sometimes miners will even that out by having stockpiles and blending grades and things like that. So there is this ramp up, but the bankable feasibility gave us a sort of false sense of security, and it's going to be sort of 10% less and 67,000 ounces a year. So our PE is actually moved up now to 9, which is still pretty good value because all the gold miners are on a PE of 20, so it's still half the price of everything else. But no one's.
It's a double. It's a double.
That's what they'll be. That's what the director will be telling you in the bar after his presentation when he's had a bit too much to drink and he doesn't think anyone's going to remember. It's a double. But of course, if we mine less, our fixed costs are going to increase because we're not mining 100,000 now. We're mining 90,000 or 88,000. A mine has huge amounts of fixed cost. Running a mill is a fixed cost. Putting stuff through the mill, Norseman Gold is a famous example of this on the AIM market. They could put twice as much stuff through their mill and their costs would barely rise at all. Their cash cost would actually halve because they're putting twice as much through. Or if you put half as much through, your cash cost double.
Yeah.
So, in fact, the cash costs have risen from 750 to 865. Now we went from 500 to 650 on the sustaining capex, and we've also got a bit of cost inflation, which sort of shocked people a bit. 10% cost inflation. It's not dramatic; happens every year. And now we're actually mining less material than we thought because of this ramp up. So our costs are now up to 865. Anyway, PE of 12. Maybe it's not a double, but there's still definitely the upside here. And now we come to the biggest mistake that maybe I'm being generous by calling it a mistake. We've not been talking about PE. We've been talking about cash flow. PE is something different because the earnings of a company is the cash flow minus things like debt servicing, minus tax, lots of other things, depreciation. So when people say this company is on a PE of 1 or a PE of 5, very often they just look at the operational cash flow of the mine, which is how much that mine is throwing off, and say, well, that's the profits for the whole company. But of course there's tax to pay, and that they've maybe got taken debt on. If we remember, we raised 200 million for this, so we've got 130 million debt that we've got to service, and that's going to reduce our income every year. We're actually already down to around $30 million a year of revenue from our original 100 million, and the number of shares has gone up from 100 million to 330 million. We're on a PE of 12, and now we're getting to an area where suddenly every extra cost really magnifies this PE ratio. Instead of going from, say, 5 to 6, if there's a bit of cost inflation, or 6 to 8 because we're doing a ramp up, when we include, say, $10 million a year of debt repayment and $10 million a year of interest, the $30 million our mine is generating, suddenly $20 million of that is disappearing to pay the people to whom we owe money. So that $30 million is suddenly dropping by 20. And from a PE or a cash flow multiple of 12, we go up to 40, just like that, just by taking into account debt repayments. And a lot of companies have a lot of debt, and companies need to raise debt because they want to minimise dilution of their share capital. So debt does make sense, but it does affect very dramatically the actual profits that a company can generate. So we've gone from 27 million of free cash being thrown off. After we've paid the debt off and after we've serviced the debt, we're down to 7 million. It's not very much at all. And then the government comes along and says, oh, gold's going up. We're doing a royalty hike. Let's say it's just 1%. So our royalties go up a little bit, and that makes the PE, takes another $1 million a year off our earnings, so we're down to $6.5 million now. And then the mine goes into production, and the directors feel very smug and self-satisfied. And
we've put this mine into production.
Yes, we've been there for 17 years doing this, and we're going to give ourselves a huge pay hike. And they decide to give themselves another $1.5 million a year. 5 directors is only a few $100,000 each. A lot of AIM directors get paid hundreds of thousands of dollars anyway. So that takes another $1.5 million over the cash we're generating. So we've only got $5 million free cash coming out of the company now. And it also turns out some more options were slipped in to tie some key management in to stop them leaving during this critical process of building the mine.
Yeah.
And there's another 20 million options that are being exercised.
Talent we wouldn't have been able to replace.
Absolutely.
Yeah.
So there's a few more shares out. We're only making $5 million a year now on a PE of 65. When there's a 20 million more shares out, we're on a PE of 69. And then we've got tax. And of course, if you make profits, 5 million, doesn't matter what you make, you pay tax. Now, this may be slightly unfair from going from a PE of 69 to a PE of 107, which is what the sort of Excel spreadsheet we've been talking through would show, because often there's tax holidays or low tax rates to encourage the initial investment. But in the long term, if we make $5 million, we'll probably be paying about a third, 35%, say, in tax.
Wouldn't it be corporation tax is what, 22% or something?
In the UK, but different countries have different rates. So it's pretty common in lots of developing countries. We're not talking about a mine in.
So even if the company's listed here, they would pay tax, and they would pay.
Yes, because the company listed on AIM would be, if they've structured it properly, there'd be a company listed on AIM which owns a company listed in the BVI, for example, which then owns a company listed in a company domiciled in Ghana, and that Ghana company makes the money and pays tax in Ghana, and then the money is repatriated. So you'll be paying around 30 to 40% tax, and that brings your profits down from 5 million to 3.2 million. So we've got 350 million shares out. were making $3.2 million a year. If the share price was still at $1, you'd be on a PE of around 100. Now, of course, the share price won't be $1, and I think Bob Hoy mentioned in an interview with you that often explorers to producers, they go from around $4 to $1.
Yeah.
And that would bring this PE ratio down from 107 to 25, which is possibly about the right sort of ratio that you might have had in the recent past. And of course, all the way through this, everyone's been saying, the big producers, they're on PEs of 20, so this is a bargain. But they're not anymore. Barrick is on a PE of around 10. And the cash flow generation, and Barrick puts it on a cash flow multiple of around 5 or 6. Now, Barrick has cash costs of around 350, including sustaining capex 450. Whatever people thought about Barrick in the past, it's not a fantastic growth company, but it's a genuine, relatively low debt, relatively high margin gold mining company that happens to be the biggest gold mining company in the world, and it's on a PE of around 10 with a cash flow multiple of 5. So if you're thinking of investing in one of these juniors, it's got to be better value than Barrick. And when you include all this dilution, obviously this company isn't going to be on a value of $1 or even 50 cents or even 25 cents. It's going to be lower than that in order to compensate for all the execution risk and the smaller company risk. So there we go, from a PE of 1 to 100. Now, there are a few extra points to make as we've gone through this. Of course, if gold goes up, then everyone forgets about all these terrible dilutions and directors' options and salary hikes and royalty increases and tax and things like that. If gold goes up from, say, $1,500 to $1,800, we're back on a PE of 12 because we've expanded our margin. And this has saved a huge number of the juniors in recent years. They have actually materially underperformed in terms of corporate activity. They've had to dilute, they've overrun budgets, their costs have increased, they're not mining what they said, but they've been saved by the gold price. And the gold price often introduces huge leverage into these smaller companies. From 1,500 to 1,800 is a PE of from 100 back down to 12, which is maybe a reasonable PE. But of course, it works the other way. When when the gold price drops by $300, they're not making money, and they basically go bust.
So all these junior mining companies, junior producers, late stage development plays, that $1,500 mark in gold, that $1,500, which I kind of think might be the floor in gold. That's the real kind of divide into whether these companies sink or swim.
For a lot of them, it all depends what the cash costs are, and this is why the market, I think, justifiably gives a lot of credence to very low cash costs. Because if you have cash costs of, say, 1,000, which a lot of the Australian miners do,
all those bulk tonnage ones,
sort of low grade bulk tonnage, very high,
which is a sector that's been doing really badly.
The Australian miners haven't really gone anywhere for a few years. The Aussie dollar is very strong. They're so sensitive to the gold price that they're just living on the edge the whole time. And that's why if you can find a miner with cash costs of 200 or 300, it's obviously a fantasy to think they'll be throwing off $1,500 profit. Because when you bring everything else in, they'll be throwing off 500. But throwing off 500 is better than throwing off zero. So low cash cost does actually mean a lot. But then Barrick, cash costs in the 300, low 400 range. If you find a miner with low cash costs, it's not as though it's the only one in the world. The biggest gold mine in the world has very low cash costs.
So what do you as an investor, what do? Do you buy Barrick? Do you still speculate in juniors? I mean, I know you play the junior game less than you used to.
A lot less, yes. I think there's value in the seniors at the moment. You can also invest in gold if you believe gold is going to rise. Maybe putting some option value on some of the miners. It's quite possible that there's a whole group of miners that if gold goes from, say, 1,800 to 2,100, they won't really be making much more money because they've got very low cash costs anyway. So they're just making another 10%, while some of those high-cost Australian miners will be quadrupling profits.
And South Africans as well.
And there may be a little bubble in those. But I think the thing to remember is these are plays. They're not. It's not retirement money. You're actually playing you're making a call on the gold price. You're investing in a particular sort of junior miner that's very leveraged to the gold price, or is very low cash cost, or whatever, depending on your risk profile, or is going to double production. Because when you go through this process, you've got to think, how much more dilution is there? How much sovereign risk is there? Is the government going to increase taxes, or is the government going to steal the mine? Are the G&A costs going to increase? Are they going to suddenly double or quadruple exploration and drilling costs? Is this a really long life mine, in which case maybe they don't need to do so much exploration and drilling? Or is it only the last 4 years, in which case they'll actually be spending a huge amount of money to find that next mine, because in 4 years' time they're going to go under. So I think you have to look at all the parameters that can cause this PE ratio, this cash flow ratio, to fall from 1 to 100, and look at your investment to think, well, how is it going to be affected by these, and what is my macro call, and therefore where does this sort of fit in my approach to risk, and what I think the world at large will be doing, and what returns this miner will be doing in those scenarios.
Well, I think, John, what you've said, it gives us a big explanation as to why so many companies in this sector are such dogs, and indeed why the sector in general is so depressed in relative terms.
Well, I think perhaps there are enough people around now who've been through several mini cycles. Maybe we're still in a commodities bull, but we've seen the pullbacks, and we've seen the sensitivity to an annual pullback of, say, $300 or $400 in the gold price, and what they can actually do to a lot of these smaller miners, and the fact that they don't have strong balance sheets, they're very exposed to the availability of debt, and if debt isn't available, then they have to dilute, and when they dilute, the valuations become crazy. I mean, just as an example, taking this mine, this fictitious mine we've been talking about, let's say they went out to sell this mine now, producing, say, 100,000 ounces a year, making 30 million cash flow, 40 million cash flow. They might only get 150 to 200 million for it, but they spent 200 million building it. And that means that that junior, before it actually started building the mine, which is what I alluded to in the previous chat we had, it was worthless, because they spent 200 million building something that was worth 165. Now, a house developer wouldn't do that. If they said, I can buy this plot of land and build a house, and it's going to cost me $1 million, but I can buy a house for 750, I just won't bother entering the house building market, because there's no margin in it. And I think that's maybe another way of looking at these companies, is look at what they'll be worth when everything's rosy and they're in production, multiply that cash flow by 4, and be a bit pessimistic on all the things that go wrong, because most of them do go wrong. And just look how much dilution, how much equity they have to raise, and that's another benchmark that you can use to value a mine. But I think, just one more comment, we have actually been grossly unfair to most junior miners out there, because, to be realistic, most of them don't even get to the first stage of what we've been talking about. Most of them never get to that bankable feasibility study. It's all jam tomorrow, promises tomorrow. They never get to the stage where they have to raise capital to build a mine, because they never manage to delineate an economic resource. So what we've been talking about, in a way, are the elite of the junior mining industry, those that actually get to that magical bankable feasibility study. That's the top 10%. The bottom 90% get nowhere and end up being lifestyle companies, perhaps, for a few of the directors who continually dilute, continually raise money. But of course, there are people that play that game, that take the private placements, take the warrants, wait for a bit of a bubble, sell the shares, keep the warrant. There's all this space. There are games to be played in all this space. But maybe as a somewhat seasoned investor now, and I like to think of myself as an investor rather than a game player, possibly you've got to accept that they are games. And if you're going to invest for capital growth and a yield and some certainty for your SIP or your retirement, this junior market is a very, very dicey place where you can make lots of money but also lose lots of money.
Well, very good. On that note, John, thank you very much. You have to turn this into a presentation, because it's absolutely brilliant. And can you give me the spreadsheet or a kind of write-up, and I'll attach it to the interview so that people can have a look at it.
I'll do a short write-up, maybe as a presentation, to go through these. I think it's the 18 stages of ruin, from fantastic riches to being perhaps the most overvalued gold miner in the market.
I think I might do the show that the 18 stages of junior miner ruin.
And no problem, yes.
Very good. And John, if do you want to give out an email address or anything if people want to find you, or would you rather remain hidden and anonymous?
I'd rather remain anonymous. I mean, I do go to all the sort of presentations in London. I'm sure if people want to find me, they'll be able to. Hopefully no executives of junior mining companies, though.
Very good. Well, John Wolstencroft, it's been a real pleasure, and thank you very much.
Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.